This simple price action trick funded my first $100,000 account, and in this video, I'm going to teach it to you. It all comes down to reading the raw language of the market through candlesticks. Master this, and you could potentially rely on this single, powerful strategy for your entire trading career. Candlesticks are the language of the market. Understanding candlestick charts is the foundation of successful trading. Candlesticks help you execute precise trades, avoid unnecessary losses, and stay on the side of strong momentum. Each candlestick is a snapshot of market psychology, showing who is in control, the buyers or the sellers. In this video, we will break down 3 types of candlesticks that will give you a deep understanding of market movements. Candlesticks do not repeat. Each one is as unique as a fingerprint, but they can all be categorized into 3 types. Surge candles are momentum candles, meaning they are signals of dominance. Pivot shift candles, or trend reversal candles, are the moments when the market changes its boss, so to speak. We'll start with surge candles, the candles that show the clear dominance of one side. But before we dive into candlesticks, let's cover the basics. The market is like a chess match between buyers and sellers. Buyers want an asset cheaply, while sellers want to sell it for more. When there are more buyers, prices rise, and sellers call the shots. If you want it, you'll have to pay up. Meaning, sellers can demand a higher price per unit of the asset. When sellers swarm, prices fall, meaning buyers acquire the asset for less. Candlesticks are a visual reflection of this battle. They show who is controlling the market at any given moment, capturing market psychology. Remember this once and for all. Every candlestick is market psychology in miniature. So, let's get back to surge candles. This is a candle with a large body and a small wick, signaling a strong price movement. For example, a bullish surge candle opens low and closes high, with a large body and a small upper wick. This is the result of powerful buying pressure, where buyers dominate the sellers. Now, the opposite, a bearish surge candle opens high and closes low, with a large body and a small lower wick. This is continuous selling pressure pushing the market down. It's a signal that the sellers are in control here. Why are the wicks small? Because the resistance was weak, like trying to stop a train with a piece of paper. The price was flying in one direction, and no one could slow it down. Sometimes candles appear with no upper wick on the bullish ones, and no lower wick on the bearish ones. These are prime surge candles, which are like a regular surge candle, but on steroids. These candles are quite rare, but their appearance is a strong signal that one side is completely dominant. For example, a 1-hour bullish prime surge candle with no upper wick shows that buyers are controlling the market without any resistance from sellers. Such candles often foreshadow a continuation of the upward movement for the bullish ones, and downward for the bearish ones. Pullbacks are possible here and context is important, but we will break that down a bit later. But in general, this is a signal to follow the momentum. There are 2 important laws of surge candles. First, catch the momentum. Such candles show the direction you should trade with. And second, do not argue with force. Going against a surge candle is like trying to swim against a tsunami. Not all surge candles are created equal. Let's consider 4 bullish candles with no upper wick. The one with the largest body is a clear signal of buyer dominance. The buyers came in here with a lot of money and full confidence. A small body, even without a wick, shows weak pressure. Yes, buyers are present, but without much enthusiasm. A large candle body is a powerful signal that the market is moving with force. A small body is a hint that there is strength, but it's not epic. The absence of a wick, even on small candles, shows continuous upward movement, which indicates buyer dominance in the market. The same works in reverse for sellers. For precise trades, focus on candles with large bodies. They provide clearer signals. We've already established that a surge candle is like a tank in the market. The larger the body, the stronger the signal. Small candles are like a mosquito bite, unimpressive. But the large ones are where the real power is hidden. One striking example of a surge candle is the so-called engulfing surge, a consuming impulse. This is when one candle literally swallows several previous ones, showing that one side of the market has decisively seized power. Imagine, 4 bullish candles were slowly creeping upward, and then bam! A single bearish candle engulfs them all. For example, on an hourly chart, buyers pushed the price up for 4 hours, and then a single bearish candle in 1 hour reverses all that progress. This isn't just a candle, it's a signal that the sellers are dominant and are paving the way for new opportunities to sell. An engulfing surge shows that the sellers accomplished more in a single candle than the buyers did in 4. It's like winning a chess game in 1 move. Now, let's summarize surge candles briefly and clearly. A surge candle is a clear signal of control by either buyers or sellers. A large body with a small or completely absent wick indicates continuous pressure. A bullish surge candle suggests a rise, while a bearish one suggests a decline. We will soon add context to make everything even clearer, but first, let's examine the next type of candle, the pivot shift candle, the moment control changes hands. If a surge candle is about dominance, then a pivot shift is about a reversal. They show how control transfers from one side to the other, right before your eyes. The key to these candles lies in their wicks. A long wick is like the trace of a failed attack. The market tried to move in one direction but was pushed back. Imagine this scenario. The candle opens, and buyers enthusiastically push the price up, but sellers reverse the movement, forcing the price back down to the opening level. The result is a long upper wick and a small body. This is a bearish pivot shift candle, which tells us that the buyers tried, but the sellers overpowered them. This wick is a signal that the buyers are losing control, and the market is preparing for a downward reversal. The same logic applies for the opposite scenario. A long lower wick shows that sellers tried to push the price down, but the buyers fought back and regained control. This is a bullish pivot shift, a signal that the market could move upward. The color here is not important. In a pivot shift candle, the wick is key, not the candle's color. Whether it's red on green or even blue with gray stripes, a joke for those who love custom charts. The story is told by the wick. A long upper wick means the sellers are winning. A long lower wick means the buyers are returning. Why is this useful? Pivot shifts give us a hint of a reversal and the chance to prepare for trades. To sell if control is with the sellers, or to buy if the buyers are in charge. This is your chance to catch the market at a trend change, like a surfer catching a wave at the perfect moment. A classic example of a pivot shift is the pinpoint. This candle is commonly known as a pin bar, but we call it a pinpoint bar for greater clarity. It's a candle with a long wick, upper or lower, and a small body, which screams, "Someone tried and failed." For example, a long upper wick means buyers surged upward, but sellers slammed them back down to earth. Such candles can be powerful signals, but only if you consider the context. We'll get to that soon. The important thing is that pinpoint bars are the same as pivot shift candles. They show a shift in control, but not just as a template. It's more like a spy report. You see how buyers and sellers are fighting for the market and can understand who is starting to win. Don't look at candles as a textbook pattern. Think about what the market is whispering to you about this battle. How do you trade a pivot shift? The general principle is simple. A bullish pivot shift, with a long lower wick, means buyers are gaining the upper hand, so we prepare to buy. A bearish pivot shift, with a long upper wick, means sellers are in control. We consider selling. But without context, it's like shooting in the dark. Now, let's move on to drift candles. The candles that say, "Nobody knows what to do." This is the moment when buyers and sellers have essentially called a timeout. No one is dominant. The market is suspended in a state of limbo. You've probably heard of a doji. This is the classic example of a drift candle. What does a drift candle look like? A small body, with the opening and closing prices nearly the same, and wicks of roughly equal length on both sides. It's as if the market tried to go up, then tried to go down, but ultimately said, forget it, and returned to where it started. Imagine the candle opens. Buyers push the price up, but sellers are like, "Nah, we're not going," and push it back down. Then, the sellers try to push it even lower, but the buyers fend them off, and in the end, the price closes right around where it opened. This is pure indecision. Not all drift candles look like a perfect doji. Sometimes the body is a bit larger, sometimes the wicks are longer, like a dragonfly, and sometimes they are short, like an umbrella. But the essence is the same. The opening and closing prices are very close together. The wicks on both sides show that the market was fluctuating back and forth, but didn't go anywhere. This signals that no one is in control here. Everyone is confused. How do you trade them? You can't trade directly based on drift candles. They don't show who is in control. So, entering a trade based on them is a very bad idea. However, they are extremely useful for two things. First, catching reversals. If drift candles appear in key zones, such as demand or supply zones, it hints that the current trend is losing strength. For example, after a strong decline, a drift candle appears. Sellers are exhausted. The market has slowed down. This isn't a signal to enter, but a sign to prepare for a potential reversal. It's better to wait for confirmation, such as a bullish engulfing surge. Second, trading breakouts. If the market breaks out of the range after a drift candle, you can trade in the direction of the breakout. Wait for one side, buyers or sellers, to take control, and use a pullback to enter. With that, we conclude the theory and will now move straight to context. Well, let's talk about context. We will analyze a situation based on my real trades. As you can notice, the start of the move could be identified by these candlesticks. Here we have indecision candles, as we discussed, when the market closes neither here nor there, more or less at the same level. This is where we wait, where we do not trade. Here, we can only observe until these candles are finished. We see a cluster of candles moving back and forth. We don't understand what's happening, and we don't need to. But here we can notice a lot of information the market is giving us. First, there is a sort of pin bar followed by a strong surge candle. What does this tell us? It tells us about consolidation and a strong move. This is precisely where the buyer's strength begins after the consolidation. If we understand my logic, that I want to enter a long trade after liquidity is taken, then where can we enter if we missed this initial trade? The optimal entry would be precisely on a pullback to this zone. Why? Because we have a strong impulse move, indicating buyer dominance. Then, on a pullback, we can consider repeat long trades. However, if we look at the bigger picture, this entire range represents accumulation for us. There is no clear certainty here. Within the broader structure, all of this is accumulation. All of this is uncertainty. All the candlesticks located here represent a zone of indecision. But what interests us is the price action itself and the specific areas where we can potentially find a trade opportunity. You can see the price starting to coil, forming indecision candles. This is a signal for an impending breakout, suggesting that the next move should be traded in the direction of the breakout, targeting the removal of all this liquidity. And that's exactly what happened. Also, remember what we discussed. Those candles showing hesitation are indecision candles, and we cannot trade them directly without understanding the context. However, after the next impulse candle, which tells us about buyer dominance, only then can we consider a strong, favorable move and proceed to trade with the trend. Why? Because the rule for trading surge candles is trade with the momentum. The next candle also signals buyer dominance. How? By the large wick that formed here. More than half of the entire candle is just a single wick. There was an attempt by sellers to push the price down, followed by a sharp recovery. Here we can open long positions. Yes, it's not the best entry point. An earlier entry would have been possible, but overall, it is still an excellent opportunity to buy, and it would be a shame not to use it.